This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello everyone, this is Chloe Walker from Financial Standard. Today we're going to be taking a look at the forecast for equities in 2023, and who better to ask than Blackrock's Chief Investment Strategist for APAC, Ben Powell. Welcome, Ben.
Hi Chloe, great to be with you. Looking forward to it.
Same here. So Ben, can you please set the scene for how equities both at home and overseas performed this year?
Yeah, so far Australia's been a rare, relatively good spot, I suppose. If you look at the performance of equities all over the world, it's been broadly a story of the commodity exporters doing not too bad. So Brazil's the best in the world, South Africa's up there, Australia. So those guys have done pretty well, including yourselves in Australia. Globally, it's been very challenging. So we're looking at global stock markets down mid-teens, 15%, something like this. So that the broad context has been hard, and Australia's been a rare bright spot so far this year.
Right. And what was BlackRock's investment strategy for both Australia and global equities over the course of 2022?
So I'd say over the course of 2022, we had to adjust to a Fed that turned out to be much more serious about containing inflation, much more hawkish than I think most people in the market had anticipated. So in the middle of the year, we cut our kind of general risk weighting and equities weighting to underweight, but maintained Asia at a neutral. So neutral is neutral, but I guess relatively more constructive this part of the world. Because we think, I suppose, that the economic damage which that tightening we're seeing, particularly from the Fed, obviously they're the big one, is going to continue to be a problem, I suppose, for risk markets, equities in particular. So the evolution of the view through the year, I think a significant moment was when the Fed really signaled that they were going to do a historic level of tightening, 4 times 75 basis points. Frankly, who'd have thought that 12 months ago? But here we are.
That's right. And what trends within equities do you think will continue in 2023? Will BlackRock iterate its investment strategy accordingly?
Yeah, we will iterate. We'll always see, I guess, what happens and where we can evolve as we go. But broadly, we think we've had the monetary policy lightening in 2022, and the economic downdraft thunder will follow in 2023. So you're already seeing this in particularly interest rate sensitive parts of the economy, housing, and all of that. And I think it will spread, the headwinds will spread into other parts of the economy, including unemployment, unfortunately, I'd have thought will rear its ugly head through the first half of next year. So what that means is earnings expectations are probably a bit too high and need to be marked down a bit as this downdraft becomes clearer and clearer. So we're a little bit cautious, I guess, overall, underweight the US and Europe in particular. On the more positive side, China does look like it's pivoted to a much more pro-growth stance across property and housing, and critically a COVID reopening. We're all going to have to see how that goes, but it does look China is serious about at least attempting to open, and that is prospectively quite good news for obviously for China, but also for the region here in Asia more broadly.
Yes, and the question that seems to be on everyone's lips: do you predict a recession for the US in the new year? And if so, how will Australia be affected?
So the definition of a recession, a technical definition of recession is 2 consecutive quarters of negative growth. I think that's a close call, like it might be plus a tenth or minus a tenth. So whether we actually get, as I say, the very definition of recession, I'm not sure, but I think it's going to feel like one. So I think the Fed is extremely serious about getting inflation down. And ultimately, although they are a very sophisticated organization, ultimately they really only have the blunt tool of interest rates. So I think interest rates are going to continue to move higher. We think they're going to get to around 5%. But then critically, we think that the Fed is not going to pivot. We think they get to 5, maybe even higher than 5, but let's say 5, and then stay there because they want economic growth to slow. They want to create a negative demand shock. I know that sounds strange, but they feel that that's a price worth paying in order to get inflation down. So it's going to be a close call technically as to whether it's a recession or not, but it's going to feel like one, and that's going to be a headwind for the global growth environment. As I say, the flip side or a different part of the global story is this potential China reopening. So you could get, and this is one of the things we at Blackrock are really talking about at the moment, you could get much more differentiation, rather than it being a global risk on, risk off, you could get a much more geographic specific kind of situation where the US and Europe and broadly the West are slowing potentially quite dramatically, and the Sinosphere, let's call it Asia writ large, potentially might be actually benefiting from this China reopening. Now, Australia obviously is kind of involved with both of those, I guess. If I think about the Australia market, if it's true that interest rates are going to continue to go broadly up, then the Australian bank sector overall should benefit from that. Banks, they do a few things, but ultimately they sell money, and we can think of interest rates as the cost of money. So you think of the price of money going up, that should be good for banks over time. And the commodity space, we'll have to see, but if China is reopening, that's what it looks like to me, that again could be quite encouraging. So a bit of a game of two halves, US slowing, China maybe accelerating, and Australia, I think, potentially placed quite well actually in the scheme of things. So let's see, but the lucky country could have another not too bad year, even as the West, even as the US maybe suffers from some of these headwinds that I've mentioned.
Well, I hope so. I certainly hope so. Now, Ben, I know we're here to talk about your equity strategy, but while I've got you, I've noted that the Blackrock Institute has mentioned rethinking bonds in 2023. Could you please share a little bit more about what that means?
I can, yeah. So look, I think it's extremely obvious but important that interest rates have gone up. Yields are much higher than they've been for the last 10 or 12 years, maybe even more than that. And I think that does present some opportunities. So we are, notwithstanding all the quite cautious things I've said about the economic outlook, we're actually very bullish investment grade credit. So when we look at investment grade credits, investment grade being the relatively safer part of the corporate bond market, you're looking at yields of 5-6%, which we think is pretty good. So you're able now to earn a real income and a relatively high yield and not take too much risk. You're not getting into some of the areas where you need to be a bit heroic. This is relatively safer, higher quality corporate credit that we think is attractive. So that's one aspect of rethinking bonds. The other aspect is less positive, is developed market government bonds. We still think yields are probably going to drift up over time. I would say the big move has probably happened in 2022. Obviously, incredible historic move up in interest rates, but we think that broadly that's going to continue. Maybe not at the same pace, but nonetheless, yields should move higher for developed market government bonds. And given, as they say, yields move inversely to price, what that should mean is the price of developed market government bonds should continue to drift down over time. So two, I think, key takeaways from our rethinking bonds. One, quite bullish or even very bullish. The investment grade outlook we think is a real tactical opportunity right here, right now. And then more structurally, strategically, we think this headwind of higher yields is going to continue. And we would suggest that people own fewer developed market government bonds than they've done historically, as we need to adapt to a new investment playbook.
Very interesting. Thank you very much for sharing those insights with us, Ben. I've certainly learnt a lot, and I'm sure our listeners have too. Thank you very much.
Thank you. Great to be with you.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.